All right, today we are digging into the latest earnings from Abercrombie & Fitch, and this one was a real head-scratcher. I mean, the report looked amazing on the surface, but it actually sent the stock in the wrong direction. Let's figure out what's going on.
So here's the big question we're tackling today. Abercrombie & Fitch drops a report with record sales, fantastic numbers, and yet the stock falls. How does that even happen? It's all about the disconnect between the headline and the details, and we're going to unpack it. Okay, so first, let's look at the big, flashy number. A record-breaking $1.21 billion in sales for the second quarter. I mean, seriously, that is the kind of number that you'd expect to see send a stock absolutely soaring.
But that's not what happened at all. Instead of soaring, the stock actually finished the day down 1.4%. So what in the world is going on under the hood here that spooked investors so badly?
All right, let's start solving this puzzle. We'll kick things off with the Q2 scorecard. You know, how did Abercrombie's numbers actually stack up against what Wall Street was expecting to see?
And check this out. On paper, this looks like a total home run. They beat on revenue, that's your top line, and they beat on adjusted earnings per share, your bottom line. By all accounts, this should have been a fantastic day for the stock. So the mystery just gets deeper, right?
Okay, so the answer really starts to come into focus when you peek under the hood. It turns out those big, shiny headline numbers, they're actually hiding a really dramatic split in performance. It's truly a tale of two brands inside one company.
And wow, here it is, plain as day. The Hollister brand is just absolutely on fire. Sales surged an incredible 19%. But at the same time, the main Abercrombie brand, it actually shrunk by 5%. Now that is the first major clue for investors. The company's growth is completely lopsided.
And when you listen to the CEO, Fran Horowitz, on the earnings call, it's pretty obvious where all the excitement is. You can just hear it. The team is thrilled with Hollister's performance. They're crediting this deep connection with teen shoppers as the real engine behind that record quarter. So for them, Hollister is clearly the star of the show right now.
So that begs the question, what about the Abercrombie brand's decline? Well, management basically framed this as a planned cool-down. For one, they were going up against a ridiculously tough comparison, a massive 26% growth number from last year. That's hard to beat. They also intentionally used promotions to clear out old inventory, which, naturally brings down the average price people are paying per item. So this wasn't really a stumble, it was more like a strategic reset.
But, this whole internal brand story, that was only part of the equation. Investors were also laser-focused on a major threat coming from the outside, a huge new cost that the company suddenly has to deal with.
And here it is. During the call, the company dropped a bomb, an estimated $90 million hit from tariffs for the fiscal year. I mean, that is a huge headwind for their profits, and it was, without a doubt, a major factor in why the stock reacted so negatively.
But to their credit, management didn't just flag the problem and leave it there. They immediately laid out a really clear four-part playbook for how they're going to fight back against these costs. We're talking shifting production around the globe, getting tougher on supplier contracts, and just tightening the belt on their own internal expenses.
And they really stressed this point. They called it their battle-tested playbook, which, is designed to show confidence that they can handle this. And here's the crucial part. They made it clear they are not going to just hike up prices across the board this year. They want to protect that value for their customers.
Okay, so let's put this all together. What's the final verdict from analysts? You've got this booming Hollister brand on one side, a cooling Abercrombie brand on the other, and this huge tariff problem hanging over everything. Let's break down how all these competing pieces create the bull versus bear case for the stock.
And you can see the split opinion right here on Wall Street. You've got the bulls, like Telsey Advisory, who are basically betting that Hollister's incredible momentum is strong enough to carry the whole company. Then you have the more cautious side, like Citi, who are really worried that those tariff costs and the softness in the Abercrombie brand are just going to weigh everything down.
So really, it boils down to this classic Wall Street conflict. On one hand, you have the bull case, which is all about Hollister's explosive growth, and the fact that management actually raised their sales forecast for the whole year. But on the other hand, the bear case is anchored by those very real tariff fears, the Abercrombie slowdown, and importantly, a Q3 profit guide that came in a little softer than people wanted to see. All right, so after weighing both sides of the argument, our call on this one, our official rating is market perform.
So why market perform? Well, here's the logic. Hollister is an absolute beast, a fantastic growth engine for the company. But that $90 million tariff headwind is just too good to ignore, and it puts a real ceiling on things for now. Plus, the Abercrombie brand, yeah, it's expected to bounce back, but it still has to prove it can get back to growth like management says it will. Until we get more clarity on those two things, the stock is probably just going to trade in line with the market.
So, looking ahead to the next earnings call, here's the big question we'll all be watching. Will management's playbook actually be enough to offset that huge tariff impact and protect their profits, especially heading into the critical holiday quarter? That's what everyone wants to know. Is the worst of it priced in, or is there more pressure still to come?
This is not financial advice.